Really, what we've seen is what used to be more of a middle market financing landscape in private credit develop into something that is a multi-billion-dollar financing alternative that is being used by some of the largest and most sophisticated sponsors and clients out there.
Private credit has become a key driver in global finance. From an asset class worth around $40 billion at the turn of the century, it now totals $3 trillion globally, competing head-on with traditional syndicated lending. Welcome to Crafting Capital, the podcast that takes you inside the rapidly evolving world of private markets. Michele, I'm going to start with you. The private credit market has certainly exploded in recent years. What is private credit and what's driving this momentum?
So at its heart, private credit, which is also commonly referred to as direct lending, is a bit what it sounds like. It is the provision of debt financing to companies directly by non-bank lenders, where there's not an underwriting bank intermediary, and it's typically more of a buy and hold strategy, long-term capital. It is not intended to be distributed or traded in the public markets. It's definitely an asset class that's been around for decades, but we really saw it start to take off around the COVID-19 pandemic volatility. That was a time where it was very, very difficult to issue in the new primary markets, and it was very expensive. Debt was trading in the 80s or low 90s, and that is very punitive from an M&A standpoint to ever try to issue debt in those environments. Private credit really stepped in at that point as a stable form of capital that would continue to lend at 1 to 2 points of discount up front. Credit spreads were elevated, just like the public markets at the same time, but it was a viable option for companies to continue to pursue M&A during that volatility. We've continued to have various different pockets of volatility over the last several years, and again, private credit really plays a compelling role in those environments. Really, what we've seen is what used to be more of a middle market financing landscape in private credit develop into something that is a multi-billion-dollar financing alternative that is being used by some of the largest and most sophisticated sponsors and clients out there.
Jeff, what do you think?
Well, I think, first of all, the private credit market has been around for a while, but it's really evolved. If you think about the history, it really started for companies that were too small to access the more syndicated markets and the high-yield bond market. And they had a lot of good attributes, which were, first lien. They had tight covenants, and they tended to be smaller companies. So that was the market for a while. And then they would graduate on to be able to access and to loan or broadly syndicated loans or high-yield transactions. But then over time, the private credit market started to go up market and look a little bit more like what was available in the institutional, syndicated market.
Michele, why would borrowers then go down the private credit route rather than a syndicated one?
Yeah, I think at the heart of it, it really is around the certainty of execution that private credit provides. You have a known outcome day one when you're signing your M&A transaction as to what your cost of capital is going to be. In an underwritten bank financing, you have an expectation of what that will be, but often your deal won't go to market for several months after the original signing. So you're inherently exposed to market volatility, and you could result in a different outcome. And borrowers really have to assess the possibility that they end up at a much more expensive cost of capital because of the market volatility that may have occurred since you originally did your deal. So I think while private credit, all else equal, is typically a more expensive cost of capital compared to a normalized, broadly syndicated market, sometimes the premium is deemed worthy of the certainty that it provides out of the gates. There are other reasons, instead of the pure economics, that borrowers may tend to go that route. But when you think about it process-wise, there is definitely, I think, some time saved in terms of the preparation and marketing materials that have to be done to approach the public markets. When you approach the public markets, you're going to hundreds of lenders instead of 5 to 10 lenders. And, that takes a lot of management time and attention. Public deals also need to be rated. So management teams have to manage those rating agency relationships. And I think at some points, there are benefits to not being subject to public rating agency action, which could ultimately have detrimental impact to the trading levels of your debt, your ability to raise new capital, the price at which you can raise new capital. I think the relative stability of the public markets at any point in time, and then some of the transaction-specific dynamics may lean issuers one way or another in terms of what's the best outcome for that trade.
Jeff, are there any other advantages for issuers from your perspective?
I think just the words private credit now, or people are talking about, it can mean different things to different people. But if we're talking more about corporate private credit to companies, which I think is, kind of the heart of what we're mainly talking about, because there are asset-backed private credit and there's lots of things in the news that aren't really what we're probably referring to as private credit. But in these structures, I think some of the reasons could be, for example, it could be size, it could be speed and certainty. There's complexity around what financial information, there's requirements of, audited financial statements. There's just more flexibility to do it in a private format. But fundamentally, over time, it can vary a little bit. Michele did a good job of some of the reasons. Some of the stories that are don't fit the syndicated markets. The investors have shorter attention spans, and some of the stories need to be told in a more sophisticated way. I think there's also sometimes maybe competitive reasons why an owner of a business would want to keep the number of people where they open their books up and let them in to all the details for competitive reasons. There's no one size fits all. Lots of companies Michele and I are working on together, we're showing them multiple solutions and they're weighing them, and markets move around, and sometimes it's a close call which direction they're going to go.
So Jeff, then how about institutional investors? What do they find appealing then about private credit as an asset class?
If you look over time, it has less volatility. It has captured that liquidity premium, whether it's 200 basis points or what, there's some premium to the more public market strategies. So for long-dated investors like pension funds, sovereign wealth funds, insurance companies, that dampen volatility and capturing that extra premium is appealing. But fundamentally, it's a more stable product if you're a long-term, large investor. It diversifies away from your public markets mark-to-market portfolio. Most large investors have liquid credit. It's part of their portfolio. And increasingly so over time, over the last 5 or 10 years, we've seen a lot of people, when you run it through the quantitative models that most of these sophisticated managers use, it spits out that you should have more private credit, which is one of the reasons there's been more and more kind of allocation to it.
Michele, from your perspective at UBS, what does convergence between private credit and the syndicated market look like on the ground when you're advising clients, and how are their expectations changing?
I think that given we've been in an environment for the last several years where unfortunately there has been less than normalized overall M&A deal flow, again, largely speaking, the markets are competing for the same opportunities. And, some of the things we've talked about already will drive an issuer's decision. But that all said, we are seeing areas where we see convergence. And, an example of that would be an issuer that we bring to the syndicated markets. They may be a first-time issuer. They may be an issuer that was in the private credit markets that now wants to come to the public markets. But there are transactions where, depending on the credit spread and price available, they can actually make sense for both pockets. And we've seen deals where both public market participants and private credit funds have joined, and they are participating in the same opportunity set. There's a number of public funds out there that are also expanding and putting in place private credit strategies, just given some of the growth that we talked about. Another area that we have seen and expect to continue to see a lot of convergence is situations where the syndicated market will take and place the first lien senior secured debt, and private credit will play an important role in a junior capital solution. The two markets can work together to provide the client both junior and senior capital, and that can work very nicely together.
Jeff, General Atlantic, GA, has been building out its private credit platform in recent years. What kinds of opportunities are you leaning into right now, and why?
Yeah, well, first I would say we've been building out over the last 6 years or so, and we have a very senior group of people who've done private credit and public markets credit investing for very long periods of time. So we started out a little bit initially doing some public markets investing, and then we pivoted to more a solutions-oriented pocket of capital. So not just regular way, kind of more, we call it flow, more vanilla private credit. We were doing the ones that, might have complicated carve-outs, a smaller business buying a larger business, requiring a little more creative type capital. So why would we also now expand into the more flow private credit product? There's a lot of retail money that's come in, a lot of new entrants. Maybe not everyone has lived through as many cycles. And so it's pretty frothy, both in most of the credit markets right now. So we are entering this with kind of a little bit of a clean sheet of paper. So we don't have to deal what happens if you have a lot of legacy problem credits. Takes up a lot of time and energy to work through. So although it's a little frothy, we are being disciplined in deploying right now. But many have the opinion that there's some cracks forming in the macro features of what's going on in the U.S. and abroad. And then also within private credit, there probably is some things going on under the surface that may distract some of our competitors. And maybe some newer entrants that have piled in will become less aggressive.
I want to talk to you both about the UBS GA partnership. Jeff, I'm going to start with you. How did the partnership with UBS come about?
In my experience, and I've worked on a lot of partnerships, is sometimes they're more check the box. We have a partnership. It really comes down to people and mutual alignment of brands, and that there's benefits both ways. So, UBS, and I'll let Michele talk about it, seem to not be, some banks want to do it themselves and others want to enter into partnerships. And I think there was first an alignment of cultures and brands. A lot of people talk about being global franchises. I think if you dig in, GA is truly a global player in what we do. UBS is a true global investment bank. They also have very significant other capabilities that they offer to corporate clients. So when we thought about who is a good party to align with, we need someone who we thought was really good in leverage finance and trying to grow that business. And we think, from our experience of using them as an issuer, they have great people and distribution, and they have a lot of global bankers and industry expertise that where the two, the 1 and 1 can equal 3. And we thought we provided good value for them too.
Michele?
No, I absolutely agree. It's about an alignment of strategy. I think each party brings something to the table that together can be impactful in a positive way to clients. So again, when you think about the partnerships that exist, most of them are built around the basic premise that the bank has an opportunity set and an origination pipeline of client relationships where those clients, for the reasons we've discussed, may choose a public syndicated deal, they may desire a private credit solution, and for GA or the bank partner, they get access to that origination pipeline, which sometimes includes proprietary deal flow without having to build an in-house origination footprint. And for the banks, you're able to provide your clients more solutions, which is good for them. And you're able to do this in a way that it's off balance sheet. I mean, when you talk about some of the ways that other banks have approached getting involved in private credit, it does vary. Some banks have chosen to do direct on balance sheet lending into private credit transactions. Some banks have their own in-house asset management arm that have scaled private credit offerings, and that is the mechanism that they use to deliver these solutions to clients. And then many, many banks have decided that a partnership is the best approach.
Michele, what should CFOs then and board members think about when it comes to the risks in private credit?
That's a topic that's been talked about a lot. Again, I think there are risks in all kinds of financing, both public markets and private markets. There are certain areas or maybe types of loans that have been more prominent in private credit, like an ARR, annual recurring revenue loan, where companies aren't cash flowing yet. I think at the end of the day, what we're all trying to do, whether it's public markets with investment banks or private markets, is find the appropriate capital structure for our clients that will work day one and it will support their growth strategy over time and continue to provide access to incremental capital, strategic ideas and solutions, M&A build-out strategies. And, both markets can be used for that. And if you make good credit decisions and you take a good view on how a company will perform into the future, the fundamentals are the same. So, unfortunately, I think you will have companies that don't work out in both public markets and private markets. And that's the nature of the business that we all operate in. But I think my message to CFOs and management teams would be your partner is important and you want to be working with people who are going to help you identify the appropriate capital structure, the appropriate amount of leverage, whether public or private is the best path for you, depending on your strategic plans, and that they will stick by your side throughout the life cycle of the financing, because naturally plans will evolve and change and you may need amendments, modifications, incremental capital. And you want your banking advisory partners or your private credit lenders to be able to work alongside you to achieve those objectives.
If you both look into the future, Michele, I'll start with you. 3 to 5 years from now, how do you think the competition and convergence, right, between syndicated and private credit will have changed the way companies raise money?
If I look over the next 3 to 5 years, I expect to see continued fundraising and capital behind the private credit product. I think it's a very compelling product that has a lot of benefits. And as a result of that, I do continue to see financings that they will scale in size. In COVID days, I think we would all look at $1 billion to $2 billion private credit financing as a very large private credit financing. We've now seen $5 to $6 billion private credit financings, and I would not be shocked that in the near future we're talking about a $10 billion plus private credit financing. I think the markets will dictate in sort of the market environment how these two markets either compete or work together to find a solution. When public markets are good, like today, we definitely see deals direct more towards the public market because the savings that can be had by accessing a diverse public group of investors can be significant, particularly for high quality, straightforward situations. We will see private credit continue to deploy in ways that will meet their return hurdles. And even that is going to evolve over time because as base rates come down, the credit spread that will be required to meet hurdles that are appropriate for private credit strategies will drive, where and how they deploy. So it's a large area of growth. And as we've already started to see, I think we are going to see expansion of the use cases in terms of the types of asset classes where private credit is deploying, just because there is such built up dry powder to invest. And there are various asset classes where private credit can be used.
I would just add that a lot of people are like, oh, so it's going to be frothy forever in private credit because it looks like that for the time being. That's why there's a lot of people in the private credit markets have been doing it for 10 years or less. If you've been doing it for over 30 years or seen the evolution of markets, I think there tends to be things that are going to be self-correcting. And then Michele makes a very good point around the other use cases. You see, the military wants to use private credit to fund infrastructure projects. Private credit is doing data center builds. There's lots of other use cases for private credit that might not just be competing for sponsors who are doing LBOs. For us, like a lot of the private credit, they focus only on sponsor deals. GA's been doing entrepreneur companies, and it's kind of our heritage for 45 years. I think having a partner that doesn't look at the partnership in a very narrow box has been something we've been very pleased, and that's part of why we did it. They think about how do we provide solutions to clients. That's how we think about it too as investors.
Michele, Jeff, what a fascinating discussion. Thank you so much for being here.
Thanks for having us.
It's really good speaking with you.
From founders weighing financing options and investors navigating capital allocation to executives preparing for their next big transaction, clearly, private credit is fundamentally reshaping how money is raised and invested today, with demand only set to grow further. You've been listening to Crafting Capital, a podcast series in partnership with custom content from the Wall Street Journal and UBS. I've been your host, Rocky Merchandani. Join us for more episodes at partners.wsj.com/UBS and be sure to subscribe on Spotify and Apple Podcasts. The content in this podcast was relevant when published on November 24th, 2025. Current views may differ.